Hey everybody, welcome back to another edition of 5 Question Friday, where I do my best to answer questions you all have sent in. I've got my cup of coffee, which I'm not sure why, because I can't drink it and talk at the same time. But anyway, here we go. So 5 great questions as always. The first one is, should we convert? Is it ever a good idea to just say, I want to convert everything, all my traditional IRA, I'm going to convert it all to a Roth. I call this the mega Roth conversion. That's the first question. Second one, if you're a government worker, military, postal service worker, you have access to the TSP, should you just say, I'm just going to invest in the C fund, which is an S&P 500 index fund, and be done with it? Is that a good idea? 3, if you're married and there's somewhat of an age difference, and you want to do Roth conversions, does it matter which spouse's traditional IRA you convert? Should you convert the same amount for each person? Does it matter? Number 4, generally the question is, how many funds should we own? This will be an interesting question based on some advice that a viewer received from a financial advisor. And then number 5, for the 3-fund portfolio, and you could apply this to anything really, do municipal bonds in a taxable account, are they an okay alternative? So those are our 5 questions. Also, I do have another calculator, free tool I'm going to show you at the end of the video that I think you'll like. I've actually got 2. I'm going to show you another one as we go. So let's get to question number 1. From Randy, I would appreciate your thoughts on when it might be appropriate to convert 100% of tax-deferred retirement savings to a tax-free Roth. So that's a great question. I call that the mega Roth conversion. The idea is you've got, say, traditional IRAs, however much is in it, but the sort of traditional approach is you spread out your conversions over some number of years so that the conversions don't put you into a much higher tax bracket. And the idea is to say, okay, what's my best estimate of what my tax bracket will be when I start spending down my traditional retirement accounts, whether because you just need the money or because required minimum distributions start? What do I think my tax bracket will be then? And then in earlier years in retirement, maybe do some Roth conversions up to that bracket or maybe one bracket lower to sort of just even out your tax liability. Always, of course, taking into account other implications for when you trigger income. For example, does it impact your Medicare premiums through IRMA? If you're not 65 yet and you're taking advantage of ACA credits, will it phase you out of some of those credits? Will it impact how your Social Security is taxed, how much of it is taxed? So there's these other factors, but sort of the starting point is a bracket, and we kind of want to just smooth it all out, right? But what if we just did it all even 1 year maybe, or maybe just a couple of years where, we kind of do go into higher brackets, but boy, it'd be nice to have it done with. So here's my take. Generally speaking, I think the Roth conversion question is largely a tax question. Now, there may be an exception to that I'll mention, but by and large, we're doing our best to figure out what will taxes look down the road if we don't convert, what will taxes look like if we do some Roth conversions now, just which one's better. And that's where retirement planning software like Boldin and Projection Lab and Prelana can come in real handy. That's the primary, that's 95% of the equation in my view. I do think there are some other factors to potentially consider. I mean, it is kind of nice to have all your money in a tax-free Roth account. You don't have to mess with thinking through the tax implications anymore. It makes just retirement planning a lot easier. Maybe you're planning for a situation where your loved one, maybe you pass away early and it's just one less thing they have to deal with. I probably wouldn't sacrifice too much money by paying higher taxes for the ease of having everything in a Roth account, but I think it's a worthy consideration. But there is another thing to think about. When we think about that tax analysis, future tax effects versus today, there is a benefit when you do a Roth conversion and you pay the taxes from a taxable account. Let me explain what I mean. Let's imagine we're going to convert $50,000. We'll assume the tax rates, state, federal, whatever you have, is 20%. So $10,000 in taxes, right? Now, let's first imagine we just do the conversion. We're going to break this into steps. So we take $50,000 from a traditional and we tell our broker, move it over to the Roth. We've now got $50,000 in our Roth. That's step 1. Now, we have to pay the taxes. So how do we do that? Well, one approach would be to say, okay, well, I'm going to take $10,000 out of that Roth that I just moved $50,000 in there. I'm going to take $10,000 out and pay the taxes. Now, of course, if you were going to do that, you probably wouldn't have put all 50 in the Roth to begin with. You would have only put 40, taken the 10 out of the traditional to pay the taxes. But I do this in two different steps because there's an alternative, and I think looking at it this way makes it a bit easier. So again, put that 50,000 in a Roth. We could say, you know what, instead of taking 10,000 back out to pay taxes, I'm going to pull 10,000 from a taxable account. And that's going to allow me to leave all $50,000 in the Roth. So those are basically our two choices. By the way, you could do some combination of that, right? You could pay $5,000 out of the amount you converted and $5,000 out of your taxable account. There's no rule that says it has to be all one way or the other, right? For that matter, you could even borrow money. I'm not suggesting that's a good idea, but maybe you've got a home equity line of credit that you might use to pay the taxes and then pay that off hopefully very quickly if you took that option, right? These really are two different steps, the moving the money to the Roth and figuring out how you're going to pay the taxes. But the key takeaway is if you pay the taxes, say, out of a taxable account, it leaves more money in the Roth. And effectively what it does is it takes the $10,000 that was in a taxable account that's now going to go to Uncle Sam and keeps it in a Roth. And of course, a Roth is a lot more tax efficient, probably an understatement, right, than a taxable account. You're not paying taxes on, well, on anything if you follow all the rules, but you're not paying taxes on yearly dividends and interest like you would an investment in a taxable account. And when you go to sell the investment in a taxable account, you're going to have to potentially pay capital gains on whatever gains you have. Of course, you don't have to do that in a Roth. Here's why I've taken some time to explain all of this. When you pay the taxes out of a taxable account and you're therefore keeping more money in the Roth, the longer that extra money stays in the Roth, the bigger the benefit. You get sort of this compounding effect so that the time in the Roth really matters. And in fact, Vanguard has done an excellent study on this, and they call it the better approach, BETR, the break-even tax rate, because this idea that paying the taxes from a taxable account will help you out as time goes by because your money's in a tax-free Roth and it's growing there rather than that $10,000 growing in a taxable account. It's going to help you, right? It's going to give you this tax-free growth, but it raises a question. How much is it going to help you? How long do you have to keep it there? How does that benefit change over time as you leave your Roth alone and you let it grow? Well, let me show you a couple of things. Here is Vanguard's paper. This is actually from August of 2022. Maybe I can make it a little better. BETR, that stands for break-even tax rate. I will link to this below the video, but it walks through the idea of just how big of a benefit is this. I will tell you that one of the factors in how big a benefit it is to pay your Roth conversion from a taxable account, one of the factors is how tax efficient your taxable account is in the first place. So if you're not buying and selling every year, like I don't generally, and if you have very tax efficient, low cost index funds, you have a very tax efficient taxable account. And so yes, there's still a benefit of paying the Roth conversion out of your taxable account, but it's not as great as someone who has a very inefficient, tax inefficient investments. Maybe they churn their account, they do a lot of buying and selling that triggers taxes, and they have high yielding investments in their taxable account. They would actually benefit even more by paying their taxes on a Roth conversion out of a taxable account. So I go to all this trouble because I found that there can be situations where you doing a mega Roth conversion, maybe not all in 1 year, depends on how much you have in a traditional retirement account and your specific tax situation. Maybe it's over a few years. When you run the numbers in a calculator like Boldin or Projection Lab, you can see that it's actually a viable strategy that can produce good results. Again, we're making a lot of assumptions about future taxes, and there's nothing we can do about that. We have to make those assumptions when we do any kind of Roth conversion. But it's this paying the taxes out of a taxable account and then enjoying years, maybe even decades, of tax-free growth that actually compounds the benefit of the Roth conversion. So yes, Randy, it can make sense. Again, my only hesitation is it's very specific to your circumstances and your own assumptions that you make, your tax filing status, your plan to make charitable contributions or not. It's very specific. Now, I mentioned that I've got a calculator. I'm going to show you that at the end of the video, but it's actually a calculator that Vanguard has put out to help you figure out how long you'd have to keep the money in the Roth to break even. I'll show you that in just a minute. All right. Great question, Randy. All right. Should government workers invest only in the C fund? This comes from a viewer named Bobby, and he was referencing J.L. Collins' book, The Simple Path to Wealth. It's a great book. I know J.L. We don't talk frequently, but we've talked in the past, and I will leave a link to his book below the video. Highly recommend it. In the book, apparently he says, I know he said this in an article on his site, so I know this is true, but this is what J.L. says. Own both the C, that's an S&P 500, and the S fund, which is basically everything else in the U.S. It's not just small cap, it's small and mid cap, in about a 70-25 balance, and you've basically got VTSAX, which is a Vanguard Total U.S. stock market fund. But this was the question, though, because JL goes on to say, personally, I wouldn't bother. I'd just hold the C fund and be done with it. So if JL Collins was a government employee with the TSP, he would put everything in the S&P 500 index fund. And so that was Bobby's question, and for his son, because his son is taking this approach right here. 60% in the C fund, an S&P 500, 20% in effectively an extended market fund, everything other than S&P 500, and 20% in the I fund, and I'm sorry that keeps popping up, I'm working on that, but 20% in the I fund, which is international. So what's my take? So JL is great, but he and I just disagree on this. He's a big believer and just put everything in the total U.S. stock market fund. I think the reason he's suggesting the C fund, of course, the TSP doesn't have a single fund that's equivalent to the VTSAX, so you would have to use a C and S to get the total stock market fund. And if I had to guess, what JL is saying is, look, it's too much trouble. If you look at the returns of the S&P 500 and compare it to the returns of a total U.S. stock fund, and if you look at the risks of both, the volatility, they're basically the same. So just go with the C fund because it's simple. I don't disagree with that. In fact, a couple of years ago, I did a video on that very point. I tend to prefer the total U.S. stock market fund because even though the returns and the risk are pretty much the same, I just like the comfort of a little more diversity. But I can't argue with JL's logic there at all. What he and I disagree on is international investments. I really believe we should have international exposure. He does not. He's in good company. I don't think Warren Buffett thinks that. I'm not sure Jack Bogle thought international funds were necessary. And you say, well, so Rob, are you telling me you disagree with Warren Buffett and Jack Bogle? Yeah, and that's okay. I have a different view. It's what makes me comfortable. I think the U.S. Economy has been phenomenal. The growth, particularly over the last 15 years, has been extraordinary. The first decade of this century, not so good. The 90s, really good. If you look at history, you basically see the U.S. Economy and public companies more or less dominating from the point in time in the 80s when they started to take over for Japanese companies. And there was a transition. By the way, that also marks the time period where we had very high interest rates, say in 82, and they started to come down, and we've had 4.5 decades of this trend, more or less, of interest rates coming down. The U.S. dollar has been the reserve currency of the world, and so we've had a lot of tailwinds that's helped us tremendously. I think that things will go well in the future for the United States economically, but I just don't see any reason to put all my eggs in one basket. So, looking back at the portfolio, I actually like what his son has done. I think this is tremendous. That's probably what I would do. What should you do? Well, I mean, that's the decision you have to make. J.L. Collins has made his decision. I've made mine. I've explained why. You may have different views on it, and that's terrific. So I think the portfolio that Bobby's son has mapped out for himself is excellent. Okay. Next one. Which spouse should do a Roth conversion first? From Martin. If a married couple, they have sizable IRAs, they have different ages. So they're going to hit the RMD point at different times. Notice he says RMD dates and divisors are different. Let me first talk about divisors. So this is the uniform RMD table. You can actually get this from the IRS. I just pulled this from Fidelity because it's a little easier to read. And this might be a bit outdated. I guess it depends on your age, right? because the RMD ages when they start have changed. I think they're now 73 and 75, right? But in any event, this is an example. It'll show you how it works. You would take your traditional retirement account balances at the end of last year, so the December 31st of the prior year. This just assumes 100,000, and you look up your divisor. So this is for someone that's 76. So we come down here to 76. The divisor is 23.7, which is based on really a joint life expectancy table that the IRS uses. And you just take your balance, divide by your divisor, and that's your RMD for the year. And most brokers will calculate this for you, and send you out your money based on however you want to receive it. But that's basically how it works, and that's what Martin means by divisor. But the question is, does it matter which traditional IRA is used for the conversion? Then it seems to be too many variant questions, age differences, account amounts, tax payments from or outside of conversion, and so on. Yeah, there are a lot of factors, but I do think it can matter. Now, the one big sort of obvious difference is that if there's a big age gap, let's say there's, I don't know what big means, let's say there's an 8-year age gap. Obviously, the older spouse is going to start paying RMDs sooner, right? And so if you do Roth conversions, for example, from that older spouse, that's going to reduce the RMDs that they will eventually pay if they've not hit the RMD age yet. And so you could save some money in those early years when that older spouse is the only one paying the RMDs. And in this hypothetical, if they're 8 years older, that's a pretty long time, right? But of course, what happens now when both spouses are paying the RMDs? And one thought might be, well, once they're both paying, it doesn't really matter, right? Because they're both paying it. Well, it kind of does, because remember, it's not just the divisor, which is based on your age, but it's also the balance of your traditional retirement accounts. So in theory, you could have a situation where doing the Roth conversions for the older spouse, yes, reduces the RMDs when that older spouse hits RMD age until the younger spouse starts to pay RMDs. But once the younger spouse starts to pay them, they could be higher than they might have otherwise been had you done Roth conversions for the younger spouse, in theory. I generally think, and my wife and I don't have an 8-year age gap, but we do have about a 3-year age gap. And my current thinking is I will probably focus not 100% on her account for Roth conversions, but we'll probably tilt it a little bit in her favor. Again, 3 years is not a huge difference. If it were more like 7 or 8 or 9 years, I might really focus on the older spouse more. But here's the thing. You can run the numbers yourself with retirement planning software. I'll just show you this briefly. This is Boldin, again, a demo account, and Dick and Jane, married couple. And I set this up, I changed their ages so that there was a difference in age. And what you can do as an initial matter is go to Insights right here, and then come down here. I hope you can see that on the screen. Required distributions, and this shows you all the required distributions. And you can see here, it'll show you the accounts that are subject to RMDs, when the RMDs start. So for the first 2 accounts, they're quote unquote my account. Again, this is a demo, but just based on the data I put into the system, RMDs start in 2028. And then for the spouse's IRA, who in this system was younger, they don't start until 2038. We can see a map of them. It shows you the first, roughly 8 years, it's just one spouse, and then we can see both spouses kick in. And what you can then do is create a scenario, create a new scenario. I won't do it now, but you could go to Scenario Manager, create a new scenario, right? And add some Roth conversions. You could try doing just the older spouse maybe, and then you could create another scenario where maybe you convert some from both spouses' traditional retirement accounts. And you can not only see things like, total tax paid and all those sorts of things over the whole life of the plan, but you can come in here and actually see the dollars, the estimated dollars that are going to be coming in through required minimum distributions. I would say my hunch is, by and large, unless you're doing significant Roth conversions, it's probably not going to move the needle a lot, would be my best guess. But again, every circumstance is different. Again, my approach would be to favor Roth conversions for the older spouse, but I'd also run the numbers, because there have been times when I, make some assumption, run the numbers, and I'm like, I wasn't quite right about that. So it's going to be depend very much on your specific circumstances. Okay. Number 4, how many funds should we own? This came up in a similar question, actually, to the TSP question earlier. This is from Eric. Eric's financial planner is recommending that he diversify his portfolio with 15% in a small cap fund and 15% in mid cap. What he says is, I use Vanguard and I have 7.5% invested in each of VSMAX and VIMAX. So VSMAX is small cap, VIMAX is mid cap. What his financial advisor wants him to do, and I might have misread this a bit, is to sort of combine those two and just put 15% in effectively what would be an extended market fund, not unlike, by the way, the S fund in the TSP. And he uses an example of VEXAX. So here's my take on this. One, I generally like to use as few funds as possible. I'll use more if there's a good reason to, but to me, fewer funds is better. For these sorts of questions, I like Portfolio Visualizer, and I created, let's see if this link works. What I did, I'll show you the portfolios. I first created just a total US market portfolio using VTI. I then created one portfolio that I call small, mid, and large, which I think is basically what Eric has done, where you've got 7.5 in small, 7.5 in mid, and the rest in VU, an S&P 500 fund. And then I've done portfolio 3, as I understand his question, effectively what his advisor is recommending. 15% in an extended market fund and the rest in an S&P 500. And I've labeled them up here. And when you analyze this portfolio, what you find is it doesn't matter. We can come down and look at, this is over a 10-year period. Here's just VTI, it returned 1381. Breaking it out, small, mid, large, 1379, 2 basis points less. Using extended market fund, in effect combining small and mid into one fund, gets you 1383, 2 basis points higher than VTI. They're all the same. In fact, when you look at the return line, most of the time it's hard to tell there's 3 lines there. So it just doesn't matter, right? Do whatever you want. Now, for me, I would just go with VTI. It's easy. One fund and I'm done. Why worry about breaking it out? VTI does it for me. Now, it doesn't break it out in the exact same ratios, as these other funds do, or these other portfolios. VTI, I believe, has roughly 20% mid cap and around 10% small cap. So the percentages are a little different, but as you can tell, at least over the last 10 years, it really hasn't mattered. So that's my take. I mean, any of these would work. I like smaller number of funds, so I would just go with VTI if it were my portfolio. All right. Last question, then we'll get to the calculator I want to show you. From William, let's see. What are the pros and cons of municipal bond ETFs as a potential alternative for the BND, which is the total U.S. bond fund, and a 3-fund portfolio, particularly in a taxable brokerage account? Well, let me just emphasize that. Not just particularly in a taxable brokerage account, but only in a taxable brokerage account, right? You would never want to own a municipal bond fund in a retirement account, right? Remember that with a municipal bond fund, the yields on a municipal bond fund are going to be lower than, let's say, a treasury bond of the same maturity. Why? Because you don't have to pay any federal income tax on it. So, but that only matters in a taxable account. So you would never put a municipal bond fund in a retirement account, right? But in a taxable account, if you need to put bonds in a taxable account, or you just want to, whether it's part of a 3-fund portfolio or for any other reason, I think municipal bond funds can be, maybe, a really good option. But why do I hedge that? Why do I say can be, maybe? The benefit of a municipal bond fund depends on your tax situation. If you're at the top tax bracket, particularly if you're also in a high tax state, then, I'm sorry about that, my watch started to ring. Then the municipal bond fund is going to save you a lot in taxes. And so it's going to give you a lot better benefit. If you're in a very low tax bracket, they really want to talk to me. I should have turned that off before I started the video. Anyway, if you're in a very low tax bracket, yeah, the lack of federal income tax isn't going to benefit you that much. Now, I know what you're thinking. You say, well, Rob, okay, that makes sense, but how do I know what the numbers are? You know, you're just sort of talking in generalities while your Apple Watch rings. Yeah, I know. I got you. We're going to go to a technology situation here and go to this. I'll even put me up in the corner. So this is a free tax equivalent calculator. If you just put in municipal bond, tax yield calculator, you get a bunch of them. This is from Fidelity, and I'll show you how it works. You can pick the product. So you notice there's in-state and out-of-state municipal. What's that mean? Well, if you live in California, and well, I don't know what the California rules are, so I should be careful. But if you live in the state that issued the municipal bond, you may not have to pay state income tax either. You don't have to pay federal, but you may not have to pay state income tax. If it's issued outside of your state, in most cases, as far as I'm aware, you would have to pay state income tax, but still not federal. So you will see that Vanguard has some municipal bond funds that are focused on a specific state, but it's very limited. Think New York and California, and you say, well, wait a minute, what about Idaho? Or pick your other, Vermont or whatever. Well, I'm guessing that those states don't issue enough municipal bonds for Vanguard to be able to set up a fund. But in any event, let's assume it's an out-of-state municipal bond. Maybe it's, again, a Vanguard index fund, and so we'll just assume out-of-state. The yield's going to be lower. I'm just going to put, I don't know what the yield is today, but we'll just say about 2.4. It's going to be lower than a treasury, but remember, we're getting the benefit of not paying federal income tax. So now we have to say, what's our estimated taxable income, right? This is important. Remember, the more you make, the higher the bracket you're in, the more benefit municipal bonds will be. So let's start out by saying, we'll put you at the low brackets. We'll say you make $50,000. Whoops, get rid of that. Do this again. And we have to select the filing status. We'll just say married filing jointly. The state, we'll put Texas because I think that's where the question comes from. Now, you could have local income tax. You live in New York City, but we'll just, for example, we'll just assume 0%. And what this does, this says, okay, what's the equivalent yield for this out-of-state municipal bond given the tax situation we put in there? What's the equivalent yield for CDs, corporate bonds, and so on? And you can see it's higher, right, than the 240, meaning with the CD, if you earn 2.75%, you'd basically end up on an after-tax basis with the same thing you'd get with the municipal bond. And you say, okay, that makes sense, maybe, hopefully, but it's only 35 basis point difference. I kind of thought it'd be bigger than that. Well, it could be. Let's say instead of 50,000, you made 500,000. Now it's jumped to 356, right? All right, well, what if you made 5 million? Now it's 385. So the more you make, the higher the brackets you're in, the more valuable the municipal bond or bond fund will be. I will link to this calculator below the video. Hopefully that helps. But yeah, municipal bonds, depending on your tax situation, can be one of many sort of tools you can use in your portfolio. But again, only in a taxable account. All right. So I promised another calculator. And this one relates to the very first question about Roth conversions and Vanguard's better strategy, the break-even tax rate. Is there a calculator out there that we can use that will kind of show us, based on whatever assumptions, how long we'd have to keep money in the Roth so that the benefit of paying the taxes from a taxable account starts to catch up and even make us even more money, so to speak, right? Well, here we go. Here it is. It's, of course, from Vanguard. And it's the Roth conversion calculator. They talk about how it works. There's a guide, which is right here. It's actually 12 pages long, but it's an easy read. I've not read it all, but I've skimmed it. And it'll walk through the details of how to use this calculator. I'll just give you a rough idea. So the idea is you're gonna figure out your current situation. So your current taxable income, your filing status. You can see the choices, here, pretty normal. They will calculate this for you. So if I add a 0, you can see it jumps to 37%. I'll put it back. By the way, same is true if I say, okay, well, we're married, it goes to 22. So they calculate that for you. You can put in current state and local tax rates. We'll just leave it at 0. Now, here's where we got to make some projections. The idea is, what will your future taxable income be? They've put in 100,000. Okay. What will your future tax filing status be? You say, Rob, there's a lot of assumptions. Yeah, welcome to the world of Roth conversion analysis. But again, you've got all these different assumptions. One thing to think about is you could model different assumptions, right? It's not like you only get one shot at this and then you can no longer use the calculator. And then your planned conversion and years until distribution, right? So in other words, if you didn't do a Roth conversion. And then how will you pay for the conversion? And they give you some choices here. So we could say out of the IRA, right? We'll talk about that. But you could also say from a taxable account, like a brokerage account, but it's very tax efficient, which would be mine. That's what I would put if I weren't paying cash. Our taxable investments are incredibly tax efficient, or if they're tax efficient would be this one. Tax inefficient, again, there's no official definition of what's inefficient versus efficient. Again, I think low cost index funds, and you're not buying and selling a lot throughout the year, it's going to be tax efficient. If you're constantly changing in and out of positions, you've got covered call ETFs, REITs that have high yields, then it's going to be tax inefficient. And then you can make some assumptions about, or calculations, if you will, about your dividend tax rate, your capital gains tax rate, your annual return. You make assumption there, your dividend yield, and then your yield on cash. And what it will do is evaluate how long you need to keep the money in the Roth to sort of break even, and then to start actually doing better. And so what do we have here? 50,000. Let's pay it out of, instead of a tax inefficient taxable account, let's pay it out of cash. So you can see our break-even point shrunk a lot. Went from 7 years with a tax inefficient portfolio. Went from a 7-year break-even point to 3 years, right? And the reason is because we weren't triggering any taxes when we sold our taxable investments, right? And we're also taking what was tax inefficient investments, whatever the tax amount is, and using that to pay the taxes, effectively then leaving that same amount in the Roth to grow tax-free. So you can make all kinds of assumptions. We could say, well, let's see, we're single now, but we're going to get married. And how does that change it? In this case, not a lot. We're going to make less money. We're going to make $10,000. That makes a big difference. And so you can play with this calculator. I think it takes a little bit of time to understand the relationships between all of these inputs. But I think if you run through a couple of hypotheticals based on your own data, it'll start to make sense. And you've also got this document, which you'll find if you just download it here. And they also have this guide here, which is kind of handy. I don't know if any of these numbers, some of these numbers may have changed because of the new tax laws, but many of them probably haven't. And it's basically a cheat sheet of all kinds of important thresholds, phase outs, contribution limits. I found it pretty helpful. Again, I didn't review it in detail to see what might have changed because of the new tax laws, but I'll leave a link to this below the video as well. And you can, so again, I think it's a pretty fun tool to play with, and maybe hopefully it'll help you figure out what's best for your situation and your Roth conversions. Let me know what you think about that. If you spend some time with it, leave a comment below the video. I'd like to hear from you and know what you think of it. And there you go. That's it for today. I hope this was helpful. I know I stumbled around a little bit, but that's just the way this channel works. So hopefully this was helpful. If you have any questions, leave them in the comments below. I'll help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.